Once we've mastered current liabilities, we then need to take a look at long-term liabilities. The difference between current and long-term is that the obligation needs to be satisfied after a year or an operating cycle. So one of the major types of long-term liabilities is considered a bond. You may have seen bonds before because bonds are normally in smaller denominations as they're being sold, but they are really a total of a larger obligation that some entity needs to borrow in order to fund a project. So those entities could be corporations, universities, and governmental agencies. And they are trying to use the money for some project or some task. You might ask, why wouldn't the corporation or entity just go to a bank and borrow the money and pay interest to a bank? Remember, banks are in the business of lending money, but their primary focus is to get their money back. And because of the risk of possibly not getting paid back, because the borrowing is so large that the bank would be exposed to major losses if the borrower did not pay the monies back, most banks will not fund large amounts of borrowings if they are the only entity that is lending to the project. So instead, many entities, corporations, universities, and governmental agencies will look to sell bonds to investors with the understanding that at the maturity of the bond, the investor will get their principal back, plus they will be receiving semi-annual interest payments while the bond is in effect. So in other words, when a corporation issues a bond, it's borrowing the money from multiple people instead of borrowing it in one large note payable from a bank. So there are several different types of bonds: secured bonds, unsecured bonds, convertible bonds, or callable bonds. A secured bond is a bond just like a promissory note or a mortgage that basically says we are borrowing the money and we're securing the repayment of the bond by the asset that's identified. Sometimes you may have known the term collateral. So if I buy an office building and I need to use a bond to finance the purchase, I might use the piece of real estate as the collateral to the bond so that if I default on the bondholders have the right to foreclose and take the property. An unsecured bond is a bond that is not secured or does not have any collateral to ensure that the bond will be paid back. A convertible bond is attractive to many investors because in many cases, instead of getting paid back in cash, a corporation will issue a convertible bond that says that at the maturity of the bond can be converted into stock. So if you're an investor and you want to buy a company, but you want to get interest first before you get the stock, you might purchase a convertible bond of that company with the understanding that at the point of maturity, you'll receive stock rather than getting your cash back. A callable bond is a bond that is just like a secured or unsecured bond, but the company has the right to pay the bond off early. Now, as the borrower, the attractiveness of a callable bond is that if you have the extra cash and you want to pay off the loan early so that you don't want to have to pay the interest, you can do it. If the bond is not callable, the bond will remain in effect until the maturity of the bond, and the interest payments have to continue during the life of the bond. When a corporation borrows by using a bond, they will issue a bond certificate to the investor. This document, very similar to a promissory note, shows that the lender will receive interest as well as the principal portion back at maturity. So, the bond certificate provides the name of the company that issues the bonds, which is the borrower, the face value of the bond, maturity date, and the interest rate that will be paid out to the investor. The face value of the bond is the amount that's borrowed or the principal due at the time of maturity. The maturity date is when the final payment's due, and the contract interest rate is the amount of interest that will be paid, normally semi-annually. So every 6 months you'll be making an interest payment on the principal amount. So this is what a bond might look like. You have the issuer of the bond, maturity date, the face value of the bond, and the contracted interest rate. Note that the contracted interest rate is an annual rate, and that if you're making semi-annual payments, you're going to be basing your interest payment based on 6 months worth of interest. While we might know the face value of the bond, that price may not be what the investor pays for the bond as the market value of the bond. The market value of the bond, or the present value of the bond, is a function of 3 factors: the dollar amounts to be received, the length of time that the amounts are to be received, and the market rate of interest. So we have to perform present value analysis to determine what the selling price of the bond will be based upon the face value of the loan, the time, and the interest rate. So assuming that Acropolis Company on January 1st, 2014 issues $100,000 worth of bonds at 9% annual interest due in 5 years with interest payable annually at year end. When we perform present value analysis, we know that money today is more valuable than money in the future. So in this particular situation where we are promising to pay $100,000 at the end of the 5th year, that $100,000 5 years from now is worth less in today's dollars. So what we can take into account that if we are paying interest and we're making annual interest payments for 5 years, that $9,000 every year in years 1, 2, 3, 4, and 5 are worth less in the future than they are today. So we could then take the calculation that the $100,000 based upon the interest rate is worth in today's dollars $64,993. The $9,000 payments, while we will have paid out $45,000 in interest over 5 years, in today's dollars, that $45,000 is only worth $35,007. So when I compare the price of the lump sum payment at the end of the 5th year and the periodic payments over 5 years, and we account for them in today's dollars, the market price of the bond is $100,000. We account for the bonds by recording them in our accounting records when we issue or retire the bonds, or when the bonds are converted from bonds into common stock. When we sell the bond, there may be 3 situations in which the bonds may be sold at. They may be sold at the face value of the bond, very similar to our example that we previously looked at here. Notice here the market price of the bond of $100,000 based upon the payments being made 5 years from now is the same amount as the face value of the bond. But that doesn't always happen. In some cases, the bond will sell for less than the face value of the bond. If the bond is sold for less than the face value of the bond, we say that the bond was sold at a discount. If the bond was sold for more than the face value of the bond, we call that a premium. The reason why we want to keep track of discounts and premiums is that we are still obligated to pay the bondholders the face value of the bond regardless of what we sold the bond for. So if we have a $100,000 bond, but we sold the bond for $90,000 and have a $10,000 discount, we need to account for that discount because we're still going to pay the bondholder $100,000. That extra $10,000 that we have to pay the bondholders is considered additional interest. If we can sell the bond for more than the face value, we do not have to return the premium to the bondholder, so therefore it becomes a reduction of the interest that's being paid. So here's an illustration. DeVore Corporation issues 100 5-year, 10%, $1,000 bonds dated January 1st, 2014 at 100, expressed as a percentage is 100%. And so we would record the entry as debiting cash for $100,000, crediting bonds payable for $100,000. We sold it for 100% of the face value. Then we say, prepare the entry DeVore would make to accrue the interest on December 31st. Well, if it's a 10% annual rate and it's an annual payment, we would say 100,000 times 10% times 1. So therefore the journal entry would be debit interest expense $10,000, credit interest payable $10,000. At the time of payment, we would then reduce our obligation of the interest payable of $10,000 and reduce our cash payment. Now, what if it's a semi-annual payment rather than an annual payment? The equation would have changed to 100,000 times 10% times 6/12. So every 6 months, we would have paid half of the 10% annual interest rate. At the time of the payment on January 1st, we would then reduce our liability of the $10,000 and show that we paid out the cash. So we would debit interest payable for $10,000 and crediting cash for $10,000. So as we were saying earlier, if we were to sell the bond for less than the face value of the bond, we have sold it at a discount. And because we've sold it at a discount, we are essentially paying additional interest to satisfy our obligation at the 10% contract rate. So if I'm paying additional interest, we're really not paying 10% interest, but a higher rate, and in this illustration, 12%. If we sold the bond at a premium, and we do not have to pay the premium back to the bondholder, and we can take that excess amount paid by the bondholder, we can take that as a reduction of the interest rate. We would therefore find that the market interest rate would be less than the contract interest rate. So here's an illustration. Assume that on January 1st, 2014, Candlestick Inc. sells $100,000 5-year 10% bonds at 98%. So in other words, they are going to receive $98,000 in cash even though they have an obligation of $100,000. So we would debit cash for $98,000, we would credit the discount on bonds payable of $2,000 and recognize the liability of $100,000 to bonds payable as a credit. On the financial statement, we would show the liability of $100,000 less the discount to show the $98,000 known as the carry value of the bond. When we see that there's a carry value that is lower than the face value, we know that we sold the bonds at a discount, and in essence we're going to be paying out additional interest. So what's the cost of borrowing? The bonds issued at a discount, we would end up showing that we had to pay additional interest. We would have to pay the $50,000 worth of interest every year. But we would have to also pay the extra $2,000 discount. So in the case of a discount, we would actually have to pay out $52,000 in the form of interest. We can prove this by saying that at the end of the maturity of the bond, we would be paying the lump sum $100,000. Over the years, we would have to pay $10,000 per year over 5 years for $50,000. So altogether, we would have paid to the bondholders $150,000, even though we only received $98,000 when we sold the bonds to the bondholders. So the difference of what we paid out to satisfy our obligation to what we received when we borrowed the money is the interest, or the cost of borrowing, of $52,000. Assume that Candlestick bonds previously described at selling 102 rather than 98. So in other words, we're paying it at 102% receipt for the sale. So therefore, a $100,000 bond, we receive an extra $2,000 worth of cash, or $2,000 less interest that we're going to have to pay in the future. So we would debit cash for $102,000, credit the bonds payable for $100,000, and credit the premium on bonds payable $2,000. From a financial statement perspective, we would show the carry value as greater than the face value of the bond because we received a premium. When we look at this, if I were to look at our $50,000 worth of annual interest payments, less the bond premium, our cost to borrow was $48,000. Once again, we can prove that this $48,000 is truly the cost of borrowing by looking that we would, at the end of the bond, we would pay back $100,000. Over the life of the bond, we would have made annual interest payments that totaled $50,000. And the $150,000 that we paid back to the bondholders, subtracted by the $102,000 that we received when we sold the bonds to the bondholders, we would show that it cost us $48,000 to borrow the $100,000. When we redeem the bonds, in terms of paying the bonds back, we've already recognized all the interest payments years 1 through 5, and we would then all have to do is show that we paid the bond off with cash. So we reduce the liability of $100,000 and we reduce the cash by $100,000. When a company retires the bond before maturity, we have to make sure that we eliminate the carry value of the bonds at the time of redemption. We record the cash, and then we record whether there was a gain or loss on the early repayment of the bond. So here's an example. Assume that at the end of the fourth period, Candlestick, having sold its bond at a premium, retires the bonds at 103. So in other words, they're going to pay 103% of the face value of the bonds to pay off the bonds. After paying the annual interest, they're going to pay the 103%. Assume that the carry value of the bonds at the redemption date is $100,400. This $100,400 is the principal amount plus the unamortized premium of $400 remaining on the bond. So at the time of the payment, where we pay 103% or $103,000, we would get rid of the bonds payable by debiting bonds payable by $100,000. We would get rid of the premium on the bonds payable of $400 by doing a debit. We would recognize the loss on the redemption of the bond. In other words, we paid more than what the carry value was. And we show that the cash we used to pay the bond off. Why would a company want to pay off a bond early when they have to pick up a loss on the bond? Consider how much interest they would have to be paying. The early retirement of the bond is far worth taking the loss than to pay the interest payment. So therefore, the company would require an early payment to save on the interest. So how do we determine amortization of that discount? We can do one of two ways, one called the straight line method and the other called the effective interest method. By far the easiest way is the straight line amortization of a discount or premium. All you take is the discount or premium at the beginning of the issuance of the bond divided by the number of payments or interest periods to get how much you'll amortize at the end of each period. So let's take a look. In the case of the Candlestick bond, where they make one annual payment, they therefore have 5 payments that they need to spread the discount over. So while they receive $10,000 worth of interest, they recognize $400 of discount whenever they make an interest payment. How did we get the $400? The discount of $2,000 times 1/5 will give you the $400. Once you've calculated the amount of amortization of the discount for every payment period, you can then create an amortization schedule to see how much the bond carry value is at any given time. Note, as you're amortizing the discount, the carry value will change. At the end of the maturity of the bond, the carry value should equal the face value of the bond. A similar situation occurs if you're amortizing a premium. In the case of Candlestick, when they sold the bond for 102%, where they received $102,000 instead of the face value of $100,000, they need to take the premium and reduce the amount of interest that's being paid. So, at the time of a $400 amortization, we would recognize interest expense of $9,600. We would recognize that there's a premium on the bond payable of $400 and that the interest payable was $10,000. Remember, the $10,000 was the guaranteed contract payment that's being made to the bondholder. The actual interest expense that we're going to recognize, the $9,600, is less because we're applying the premium against the interest. We can then get an amortization schedule that looks something like this. Notice at the end of the 5th year, the carry value equals the face value of the bond. We can also do the effective interest method to amortize the premium or discount. When we do that, we have to take into account the contract interest amount versus the market interest amount. The contract interest amount is the amount that we actually pay out to the bondholder. The bond interest expense is the amount that we're taking based upon the effective interest rate. So let's take a look here at Candlestick using the effective interest method. Candlestick once again sold the $100,000 face value 5-year bonds at 10%. They sold it for $98,000, so we know that there's a $2,000 discount. We need to spread that $2,000 discount over the 5 years. So we would create a schedule that looks like this. Notice in column A, we're still paying $10,000 to the bondholder every year. The interest expense, though, would be calculated based upon the carry value of the bond at the interest rate. So we would take 10.53% times the $98,000, which is the carry value, to get the amortization of $319,000. We would see then that the bond carry value for the discount would increase the carry value to $98,319. If we carried on this calculation for each year, the carry value would come up to $100,000. So in other words, you can see where the straight line method and the effective interest method would get you to the same place at the maturity of the bond. The question is do you want to base the interest spread over the life of the bond evenly in the straight line method, or do you really want to apply the interest against what is actually due? So at the time of the discount, we would do a journal entry that would recognize the interest expense of $10,319 because it's a discount, but then we would recognize that we had the discount of bonds payable of $319 as a credit and a credit to the interest payable of $10,000. So the journal entry would look something like this. What if it was a premium? Once again, remember it was sold at 102%. So we would have to figure out how to do an effective interest rate of 9.48%, and we would multiply it against the carry value. Notice the 9.48% is less than the 10% because we're applying the premium against the contract interest rate. So while we still are going to pay out $10,000 per year, we would recognize less interest expense because we're applying the premium to the interest. Notice once again at the end of the 5th year, we will have our carry value equaling our face value. The journal entry to record the interest then would be a debit to interest expense for $9,670. We would show the reduction of the premium of $330 and that the interest that's payable to the bondholder of $10,000.